Good morning, everybody. I'll make it around about 11:30. Welcome to this webinar on the Share Incentive Plan. Just to let you know a little bit about the webinar itself, it's going to last around about 30 minutes or so. You can ask questions online afterwards, or if you want to drop me an email with questions, my email details are there. I will also share the webinar online if you or some of your colleagues want to see it after you've seen it, so you can revisit it at any time in the future if you want to do that. Just a little bit about me. My name's Sarah Anderson. I'm a share scheme solicitor. I've been working in the field of share plans for around 20 years now, focusing almost exclusively actually on share plans for private companies. There are my contact details if you want to call me or email me anytime with questions about share schemes, generally about the webinar in particular. This webinar is intended to be a practical outline introduction to the Share Incentive Plan, or SIP, rather than a particularly technical seminar. I'll be talking about the key benefits of the scheme, the key requirements, and how you can set one up. And I'll also explain how the scheme works generally, including an example of how one of our clients used it to the best effect. So to start with, excuse me, what is a Share Incentive Plan? It's commonly known as a SIP. It was created back in 2000, so it's been around for a number of years now. It's a government recognised plan, what used to be called an approved plan, now known as a tax advantage share plan. And that's a pretty good name for this particular type of scheme, because if you use it correctly, it can result in zero tax rates, both from an income tax and capital gains tax perspective. And that's for the participants, as well as zero NICS rates for the company as well. There are obviously rules that you have to follow to get that level of tax advantage. So any SIP must be made available to all of the employees in the company, and it involves actual shares held in a trust rather than share options. Within the limits of those rules, however, the scheme is actually very flexible in the way it works, allowing shares to be gifted to employees or bought by them, and also incorporating a bog-off arrangement, buy one, get one free. Actually, in this case, a buy one, get two free arrangement. And the plan's intended to encourage long-term motivation and reward for employees. The legislation actually states that it is intended to provide employees with a continuing stake in the company. So if that is your intention, then SIP really is your go-to plan. I'm going to start with the key tax benefits. Obviously, you should never implement an employee share plan purely for the tax advantages, but it is undeniable that the SIP is absurdly tax efficient. There is no income tax or national insurance contributions to pay when a share is gifted to an employee. And if the employees buy shares via the SIP, they buy them out of pre-tax salary. And when the employee eventually sells the shares, assuming certain rules are followed, there's no capital gains tax to pay either. So from the company's perspective, the no NICS to pay includes employers' NICS as well as employees. So there's a saving for the company as well, which can be significant. In addition, there's corporation tax relief for the company. The company can claim a deduction for the costs of setting up and running the plan, and there's also a further corporation tax deduction for the market value of certain shares given to the participants. In addition, in some circumstances, founders can sell their own shares into the SIP to obtain a capital gains tax relief on that sale. Again, certain rules apply. So you can see that all around, SIP provides some quite significant tax advantages, and it is actually probably the most tax efficient share scheme available in the UK, even more tax efficient, in fact, than enterprise management incentives, because it enables people to get shares free and pay no capital gains tax on the sale. Some of the other key benefits of SIP, in my view, is the flexibility and choice that the plan offers. It does allow employees to get hold of shares in their employing company in a variety of ways. So each employee can receive free shares of up to £3,600 worth each year, tax and NICS free. They can also buy up to £1,800 worth of shares out of pre-tax salary. Those are known as partnership shares. And then finally, they can receive up to 2 further shares, again, free and free of tax and national insurance contributions, for every partnership share that they purchase. That's the buy one, get two free point I noted earlier. So each participant under a SIP can receive a maximum allowance of £9,000 of shares each year, which over a period of time obviously can really add up. Another advantage of SIPP is that even though it's an all-employee plan, it doesn't necessarily mean that owners are giving up control of their privately owned and managed company. So to begin with, you can use non-voting shares in the plan if you're worried about employees grasping control, getting control away from you. Remember that the awards are only ever going to be made in accordance with the company's wishes, so there's always control over the number of shares that can be acquired by employees. So, for example, you might just want to make a one-off award of free shares to employees who to recognise the fact they've been working with you for a long time, or something along those lines. You don't need to repeat the awards. You can do what you want, and you can limit the number of awards that you're giving at each award under the SIPP in any event. So there's no obligations to carry on making awards under the SIPP, just one-off, just to make sure that you're not giving away too much of the equity in the company. Also, you can make sure that if people cease employment, their shares don't go with them. Shares that they've not paid for, the free and the matching shares, will usually be forfeited if they leave within 3 years of the award. Otherwise, the shares can be sold back to the SIPP trust when people leave, and then those shares can be recycled by the share incentive plan to use under future awards for other employees in the future. So those are the main benefits of the SIPP. As I noted, the tax benefits do mean that certain rules have to be followed. So now I'm going to talk about the key requirements. The first of which is that you will need, in order to run a SIPP trust, and of course trustees to run it. A SIPP trust must be UK based. It must hold the shares on behalf of all of the employees, and it must operate within the terms of the SIPP legislation. So, unlike other employee benefit trusts, it doesn't really have any discretion. It has to follow specific rules. It's quite common to have an independent professional trustee running a SIPP, especially for larger companies, although it can be run with independent individuals operating as trustees if that's preferred. The key thing that trustees must remember at all times is that they must act in the best interests of the beneficiaries of the trust, i.e. the employees of the company. The SIPP trust has some particular advantages other than the tax advantages I've previously noted, especially for private companies. It's a really good way of ring fencing a certain proportion of shares for employees. It can recycle shares from leavers, so rather than having to go through the rigmarole of issuing shares and then buying them back from leavers and cancelling them or putting them into treasury, you can use the SIPP trust instead as a marketplace of the shares. So then you can use it as an internal market for employees in a private company. And there's an example of how one of our clients did this a little bit further along in the presentation. The key thing about the trust is that for as long as SIPP shares are held in the SIPP trust, any gains will be entirely free of capital gains tax. So for employees, there is little advantage actually in taking the shares out of the trust, because that removes that tax shelter for them. Another of the key requirements is that a SIPP must be offered to all employees in the company. The main purpose of the plan, as I mentioned earlier, is set out in the legislation. It must be set up to provide employees with a continuing stake in their company. And note that the main purpose for setting up the share incentive plan must not be the avoidance of tax. So all employees have to be included, although you can include some but not all subsidiary companies. So for example, if there's a group and you've got overseas subsidiaries, you needn't extend the SIPP to those overseas subsidiary companies. There'll be little point in doing that because the tax advantages may not work overseas. Crucially, employees must participate on the same terms. So that doesn't necessarily mean you have to give everybody exactly the same number of shares, but you must make sure you don't end up with higher paid employees being the main beneficiaries. So you can vary the number of free shares that you're giving out by reference to specific measures, which are hours worked, salary or length of service. For the partnership shares, the shares that are bought out of pre-tax salary, you've got a natural limit of £1,800 per annum that people can spend. So it's quite hard for higher paid employees to benefit disproportionately because the limits are quite low. Do know you can set a qualifying period of up to 12 months employment before employees are invited to participate. So if you make an award today, you needn't worry that somebody only just joined 2 months beforehand. They can wait until the next year's award without falling foul of the SIPP legislation. And do remember that majority shareholders can also participate in a SIP as long as they're employees. In fact, you must invite them. Whether or not they choose to take up the offer is up to them, but you can use a majority shareholder, offer of majority shareholder shares under a SIP trust if you wish to do that. And the final point relating to SIP is that it's a long-term plan. The maximum tax benefits will only accrue at the end of 5 years, and if shares are taken out of the plan before that time, there may be a clawback of the tax benefits. So, for example, on the date of the award, if you give somebody free shares, there's no income tax and there's no national insurance contributions charge. If the shares are taken out of the trust within 3 years, however, income tax and NICs will be charged on the market value of the shares at that time. If shares are taken out of trust between 3 and 5 years, then you have the IT and NICs charge based on the market value of the shares at either the date of award or the date they're taken out of the plan, whichever is the lower. So the tax treatment is kind of tapered over a period of time. As long as the shares are left in trust for more than 5 years, there can't be a clawback of those tax benefits. And there also won't be a clawback if an employee is a good leaver. Good leaver is set out specifically in the legislation. There's no discretion there. It's for reasons of injury, death, disability, that kind of thing. So there are specific good leaver reasons. And also, if the company is sold or taken over where consideration paid is cash, if that happens within 3 years of the SIP share awards being made, there's not going to be a callback in that situation either. So if your company is sold for cash, you don't need to worry about the clawback then either. So having looked at the tax benefits and the other benefits and the key requirements, how do you actually go about setting up a SIP trust? Well, there are some, like I said, most of life there are some must-haves and there are some nice-to-haves. So I would say you definitely need the following: some kind of design blueprint. You mustn't underestimate the importance of this first step. You need to know how much equity you're planning to use, how you anticipate using the flexibility offered under the SIP. So, for example, are you going to be using free or partnership or matching shares or a mix of some or all of them? One of the things you'll need to think about is how the company is going to fund the arrangements. So, of course, if employees are buying shares and payments being made for the shares, but if shares are being offered free, companies will usually need sufficient profit reserves in order to dole out those free shares. You also need to think about how often you might want to make the awards. Remember, you're not tied to one type, you can vary it over time. So, for example, some of our clients might start off with an offer of just free shares or just partnership shares to build interest at the start, but they might review the offer in future years, for example, by offering extra matching shares. And also remember that matching shares ratio, you can offer up to 2 matching shares for each partnership share bought, but that ratio is very much up to you. As long as you don't exceed it, you could say everybody buys 10 partnership shares and they get 1 matching share for each 10 partnership shares that they buy. So that's very much down to you, how you want to design the plan. Because it's so flexible, there are plenty of things to think about. You probably need to kind of really have a clear idea about what you want the plan to do and how it's going to work using those different types of share awards. Mentioned the timetable. That's quite important because there are various steps that need to be taken before you can get the SIP up and running. For example, setting up the trust, identifying and appointing the trustees, opening a trust bank account, when everything to do with banks takes ages. Trust bank accounts no exception. You might, however, want to take advantage of that lead time by planning your communications program. So, for example, some of our clients will start with a little tease about what they're going to do when they're going to establish the plan, and then over time giving more information and culminating in a proper full launch when they're in a position to send out the first invitations to employees and all the details have been sorted out. You will need a set of plan rules, which need to comply with specific tax legislation, and you need them to set out how the plan operates. So we can award free shares, we can award partnership shares, and what happens to leavers and so on and so forth. You'll need a trust deed and a trustee. So a deed setting up the trust, usually attached or incorporated into the rules of the plan. The trustee who will operate the trust. So effectively it's the trustee's job to make the share awards to employees and to hold the shares on behalf of the employees and to buy shares back from employee leavers when it's required. The trust needs to obviously act within the rules of the plan and in the employee's best interests, but it will also usually take instructions from the company's directors. So, for example, the directors will resolve they want to make a free share award to all employees in April, and the trustees will put that into operation. But if the directors resolve to make an award only to certain key employees, and the trustees can't do that because they won't be operating within the rules and they won't be operating within the legislation. So it's really important that the trustees have an understanding of how the SIP should work and have an understanding about their duties as trustees generally and of the SIP in particular. So private companies will quite often have individual trustees carrying out this role. Sometimes they find it easier to instruct an independent corporate trustee that's used to operating SIPs for companies and understand the rules. And some of them do a mixture of the two. So for example, we act as corporate trustee for lots of our SIP clients, and in some cases we have RM2 trustees sitting as a trustee alongside two individuals who might be directors of the company. So they have the input from the company perspective and we can assist them with the decisions they're making and keep their records correct and so on and so forth. I've mentioned you need to set up a bank account for the trust. The trust needs money to subscribe for shares in order to make awards to the employees, and it might need funds to buy shares back from leavers. If employees are buying shares, then the trust will need to use their salary contributions to buy the shares for them. And then in addition, you have approval of shareholders, board resolutions. It's advisable to get shareholders' approval to establish a SIP. It would certainly be normal to have a board resolution confirming that the plan's been adopted and recording when awards are going to be made, or when the directors tell the trustees that it's time for another award and we want to make it on this basis. And the trustee will also need its own records. Again, if it's a corporate trustee, in the form of board minutes. Partnership and free share agreements are the actual agreement that each employee must enter into in order to participate in any SIP offer. If they're going to buy partnership shares, they need to agree how much money they want to set aside, whether it's a one-off or on a monthly basis. And the agreements will also contain information about what happens if they cease employment. For example, will they lose their shares? If employees don't complete an agreement, they won't be able to participate in the SIP. So there's quite important documents. And you can add to those obviously with relevant employee communications documents or FAQs or whatever you think suits your workforce best. You also need a share evaluation agreed with HMRC, especially if you're a private company. It's increasingly difficult to get HMRC to agree a private company share valuation, but they are currently required to do so for the launch and award of shares under an employee share scheme like the SIP. So what we will usually do, for example, if you're making annual awards under the SIP, you just kind of repeat the same valuation process each year. Make sure that you're applying your valuation methodology on a consistent basis, so you don't have unnecessary jumps up and down with share price, or at least out with the vagaries of the market and how your company is performing. There are a couple of other things. I've mentioned a well-organised payroll. We do find well-organised payroll departments are actually vital, especially if you're using partnership shares. You need all the participants' details, NIC's details, and so on and so forth. So we love a well-organised payroll when we're putting SIPs in place. You might also benefit, these are the nice to haves. You might consider amending your articles of association. So for example, if you want to create a different class of shares, you might want to do some more detailed equity modelling to work out exactly, how much equity over a period of time, assuming so many employees, so many leavers, how much is a SIP actually ever going to acquire. I've mentioned the independent trustee point, and the communication strategy is like that. That will depend very much on your workforce. If you've got lots of people in different sites, what kind of jobs do they do? How much knowledge do they have about share capital or finances? That's going to need tailoring very much to the kind of employees that you do have in place. So once the plan's set up, how does it actually work? Well, here's a kind of fairly simple step-by-step example. So firstly, the company sets up the SIP trust, sets up the plan, sets up the trust that was going to hold the shares on behalf of the employees. The company then invites employees to participate, whether it's free shares, matching shares, a mixture of those, partnership and matching. And they do that by entering into a free share agreement or a partnership share agreement. if employees accept, they can then participate in the SIP. They'll need to allow for a salary deduction if they're buying partnership shares. The company will then issue the shares to the trust. And actually at this point also, if you have a founder who wants to sell the shares to the trust, this is the point at which the trust could buy the shares from the founder as well if required. And then the SIP trust sits and holds shares on behalf of the employees, and the shares usually just stay there until something happens, for example, a leave or something along those lines. Basically, it'll just sit and look after the shares on behalf of all of the employees, and that's where the SIP trustees come into play. And then over time, if an employee's been awarded shares, even if they're held in the SIP trust, he or she is entitled to dividends on those shares if they're paid. So dividends can be paid to employees, and as people leave, the shares can be sold back to the trust by the leavers and then recycle for future awards. So that's a fairly simple outline of how the SIP trust will work on an ongoing basis. A few things that you need to be aware of after the first awards have been made. You need to register the plan with the Revenue on their online employment-related security system. You need to submit an annual return for the share plan each year. Keep records of the awards made, leavers and the reasons for leaving. You need to know the reasons for leaving because the legislation sets out what a good leaver is. So you need to make sure that if you're treating a person as a good leaver, they do fall within the requirements of the legislation. Generally, we advise you keep records of all correspondence with the Revenue, especially valuation agreements. And also when you're registering the plan or sending the annual returns on their online system, we usually advise you take a screenshot because that's the only way you can prove that you've submitted your return. And brutally, sometimes the ERS system isn't always 100% efficient. So just to make sure that you can prove to HMRC you have submitted your returns on time, we always do a screenshot and keep it on file. The company's going to need to liaise with the trustee, of course, throughout, including funding if required. And the trustee, meanwhile, will usually need to submit a trust return. The key thing, again, ensure it acts in the best interest of the beneficiaries and generally ensuring it must act in accordance with all its powers and duties. So a key one, for example, is that a SIP trustee must not pay more than the market value for the shares that it's buying. We've got about 5 minutes, so I thought I would just run through a quick case study. This is a client of ours that set up a SIP called the Heron family, mainly Mr. Heron, but the Heron family owned 100% of Heron Limited, let's call it. Mr. Heron didn't really have any particular plans to sell the company. He did want a succession plan. He wanted his workforce commitment and loyalty to be strengthened, and he also wanted participants in any share plan to be provided with a very clear economic benefit. He was very much looking at the long term, and crucially, he did want to retain some interest for the Herons, including all the Heron children. So we set up a share incentive plan and a SIP trust for him, for all employees. We awarded shares to those employees. We used a length of service and salary band and worked out a point system to appropriate the correct number of shares on a mixture of both loyalty and seniority. Leaver shares were recycled through the SIP trust. Employees were able to sell their shares back to the SIP trust, provided the SIP trustees could see that there was a further way out for those shares. You can just buy shares and sit on them forever. You need to be able to allocate them out at some point. But because regular awards were being made, it was perfectly possible for SIP trustees to buy shares back from leavers and then make use of those shares in the next year's awards. So the way it worked is Mr. Heron himself actually sold shares into the SIP, so that his interest in the company was reduced and the SIP's interest was increased. And the employees received free shares, and when leavers left, they would sell free shares back to SIP recycling. So the employees' percentage was increased over time as well. And time went by. This wasn't a very big SIP, it was only about 45 employees, and the free share awards were made annually. We agreed annual SIP valuations with the Revenue. and the SIP shares, when bought back leavers, were always bought back at the latest agreed market value, so there was never any kind of doubt that SIP trustees were paying more than market value for the shares. The company also had, separately, I haven't put into the diagram, there ended up being too many boxes, it also had an EMI scheme in place, and an EBT. So the EBT would buy back shares and use them for the EMI. The SIP couldn't do that because the SIP can't be discretionary. So the whole scheme had two separate parts to it. The SIP was for all employees, and the EBT and the EMI was for particularly key staff. And every year, all the shareholders got a nice dividend. Employees were able to sell their shares for those occasional, big holiday requirements. And then one day, although Mr. Heron wasn't really looking for a buyer, sometimes there's an offer that's too good to be true, and that offer came along in 2017 and the company was sold. And the shareholding sale, Mr. Heron had reduced his particular interest to around about 65%. He'd retained a decent chunk for the children, and the employees, by the time of the sale, held the best part of 20% amongst them. So everybody did quite nicely at the sale. The key thing, however, was that the Herons retained the majority interest. The SIP employees sold their shares completely free of capital gains tax. The staff had been retained, which is exactly what Mr. Heron wanted to do over a whole 10-year period. They'd seen an economic benefit, both by way of their dividend payments and by the ability to buy and sell shares in an internal share market. The most exciting thing for us was Mr. Heron felt that there had really been a significant impact on company culture and reward. The SIP was very well communicated, everybody understood it, and they felt it was a really fundamental part of the way the company worked. And obviously they benefited financially from it when the sale point arrived. So the owner's vision was achieved by a really nice mix of SIP for all employees and EMI for key employees. So, we're always sad to see clients sell, because then they cease to be a client. There is no share scheme to run anymore. But it's really wonderful to see a vision achieved by way of a well-designed and well thought through share scheme like that. So that's really the end of the webinar. As I say, the SIP is really a go-to scheme if you are looking for all employee ownership and an equitable long-term form of share ownership for employees. Very tax efficient, and it's pretty flexible within the rules that apply. So it's one of my personal favourite schemes. So if you do have any further questions about it, if you've got any clients, or if you feel that a SIP might be useful for your employees, do get in touch, and I'll be happy to speak to you in a bit more detail about how it operates in your particular situation. So for now, I shall just check if any questions have come in. Sometimes you can have there's a little online question session. If anybody wants to send in a question now, I can try and answer it if I can read that. Let's have a little look. I have a question. Oh, is it possible to have a copy of the presentation? Yes, I can send a copy of the presentation, but it will be on our website in any event, so I can send a link out after this webinar is finished. I am told you will receive a follow-up survey from SurveyMonkey, so it'd be really helpful if you could fill that in so we can keep improving these webinars and making them useful. As I say, if you've got any other follow-up questions, just drop me an email or phone me. I'm always very, very happy to talk to anybody about share plans at pretty much any point. So for the time being, that is the end of the webinar. Thank you very much for your time. I appreciate you turning up and listening. I hope you found it helpful, and do get in touch if you've got any other questions. Thanks.